Welcome to this explainer. I'm absolutely thrilled you're tuning in today because we're going to dive right into a startling mathematical reality behind cars, debt, and building actual wealth. We're unpacking some truly fascinating data straight from our source materials, including reports from the Consumer Financial Protection Bureau, financial analysis from Finance Buzz, and some hard-hitting insights from Dave Ramsey. We're going to look at the exact numbers that are literally keeping everyday people from reaching their financial goals, and then we'll explore the step-by-step methods that others are using to completely break free. So settle in because you are definitely going to want to remember this math.
Okay, let's kick things off with a pretty massive question drawn directly from a national study of millionaires by Ramsey Solutions. They surveyed over 10,000 U.S. millionaires to find out exactly what habits helped them hit that seven-figure net worth. They weren't looking for magic tricks or get-rich-quick schemes. They were looking for common behavioral denominators. So, what do you think was one of the single most significant factors these wealthy individuals pointed to?
The answer is avoiding car payments. Exactly 84% of those surveyed pointed to staying out of auto debt as a huge, massive factor in their financial success. Now, while it's important to note that this was internal company research and not an independent academic study, the foundational principle here is incredibly straightforward, right? Reducing your debt obligations simply creates more room in your budget for things like retirement contributions, emergency savings, and long-term goals. Because every dollar you send off to a lender is a dollar that isn't being invested in your own future. To really grasp why 84% of millionaires avoid this specific type of debt like the plague, we've got to examine the underlying mechanics of car ownership.
Section 1. The depreciation trap.
Let's look at the current landscape for a second. According to Experian data from early 2026, the average new car payment in America has hit a staggering $770 a month. I mean, that is a massive chunk of the average household's take-home pay just automatically siphoned out of their bank account every 30 days. But you know what? The size of the payment is actually only half the problem. The real wealth killer is what that $770 is actually buying.
And that brings us to the core issue, depreciation. As our source material from Wikipedia notes, depreciation in accounting refers to an actual reduction in the fair value of an asset. Basically, as a vehicle gets used and wears down over its expected useful life, its value just drops. So, when you finance a car, you're paying interest on an asset that is rapidly losing value. You are literally paying a premium to borrow money for something that is mathematically guaranteed to be worth less tomorrow than it is today.
Personal finance personality Dave Ramsey hits the nail on the head with this. He constantly points out that cars drop in value like a rock, yet so many people get caught up in this endless cycle of lifestyle inflation. You know the drill. You get a raise, your older car suddenly feels a little embarrassing, and you upgrade because the new monthly payment seems, quote-unquote, manageable. As Ramsey famously puts it, people repeat this upgrade cycle and take on payments just to impress strangers at a stupid stoplight that they will never even meet. But remember, just because something is affordable doesn't mean it's helpful. Upgrading constantly puts a permanent claim on your future income.
Section 2. Understanding negative equity.
So how does this build into an even deeper financial pitfall? Well, let's talk about negative equity. It simply means owing more on a loan than the underlying asset is actually worth. You've probably heard this referred to as being underwater on a loan. And how exactly does this happen with cars? Well, when you combine that rapid vehicle depreciation we just talked about with loan terms that are stretching longer and longer, with Experian noting that nearly 36% of new car loans in early 2026 ran past 6 years, the math just totally turns against the buyer. The car's value drops way faster than the loan balance is actually being paid down.
We actually have some eye-opening data on this from a recent Consumer Financial Protection Bureau, or CFPB, report. They analyzed a massive auto lending dataset spanning from 2018 to 2022, and the breakdown is super revealing. While 56.3% of vehicle loans had no trade-in and 32.1% involved a positive equity trade-in, a significant 11.6% of all vehicle loans included negative equity. That means more than 1 in 10 buyers literally had to roll the leftover debt from their old, depreciated car into the brand new loan for their next car.
Now, this is where the ripple effect gets really severe. The CFPB report found that consumer outcomes for folks who finance negative equity seem to be significantly worse. Borrowers doing this face more than double the risk of having their vehicle repossessed within 2 years compared to those with positive trade-ins. Because they're financing the new car plus the old debt, they end up with much larger overall loan amounts, and that results in monthly payments that are 27% higher than average. Furthermore, the data shows these borrowers generally had lower credit scores and lower household incomes to begin with, making the whole situation even tougher.
And the disproportionate impact of this debt cycle is pretty striking.
The CFPB data shows that the burden of negative equity falls heaviest on those buying less expensive vehicles. Nearly 25% of consumers financing vehicles in the $20,000 to $29,000 range finance negative equity. Compare that to just 16% for those buying vehicles priced over $50,000. So the borrowers who can arguably least afford the extra debt burden are the very ones most frequently absorbing it.
Now it is important to impartially note the differing perspectives on this data. Following the CFPB's report, which suggested they're going to more closely examine lender practices regarding negative equity, the American Financial Services Association, or AFSA, issued a statement. While the AFSA appreciated the CFPB's clear and objective reporting of the data, they did push back slightly on the Bureau's view. The AFSA disagreed with the CFPB's claim that detailed information about the auto finance market is limited or non-existent, and they asserted that extensive data on this market is actually already readily available.
Section 3. The opportunity cost.
So the absolutely crucial point here is understanding what you lose by tying your cash up in these underwater depreciating assets. This brings us to the ultimate financial crossroads. When you make a car payment, the true cost extends way beyond just the interest rate on the loan. It's really about opportunity cost. Let's compare the two mathematical paths. On one hand, you lock your income into financing a depreciating asset, meaning you are literally paying interest to hold on to something that is losing value every single day. On the other hand, you invest in an appreciating asset. By avoiding that car payment, you free up cash to put into investments that not only gain value but benefit from compound growth over decades.
To help you gauge exactly where you stand, financial experts offer a really useful benchmark. They suggest keeping your total transportation costs under 10 to 15% of your monthly take-home pay. And I want to be super clear here. This isn't just your car payment. This percentage has to include the loan, your fuel, your insurance, maintenance, registration, the whole shebang. If your total transportation costs are flashing red and blowing past this 15% mark, your vehicle is very likely crowding out other vital financial priorities, like building up that emergency fund or saving for retirement.
Section 4. Breaking the debt cycle.
Now, if you're looking at your own budget right now and realizing your transportation costs are way too high, don't panic. Dave Ramsey's method provides a straightforward 3-step roadmap to break this cycle and reclaim your future wealth. Step 1. Save up and pay cash for a boring, reliable used car. Just skip the vehicles designed to impress others and focus entirely on utility. Step 2. This is the critical one. Once you have no car loan, you must immediately redirect what would have been your old car payment into an investment account, like a workplace retirement plan or an IRA. If that freed up money just vanishes into extra restaurant meals, you haven't really built wealth. And step 3. Create a separate vehicle replacement fund so that when your reliable used car finally does give out, you already have the cash ready and you don't fall right back into the loan trap.
The sheer scale of the math when you follow those steps is absolutely mind-blowing. Remember that average $770 monthly new car payment from Experian we talked about? Well, Ramsey points out that if you took that $770 a month and instead of handing it over to an auto lender, you invested it in a mutual fund from age 30 to age 70, it could grow to a staggering $9.1 million. Literally, think about that. $9.1 million. That is the pure mathematical power of compound growth over time versus the drag of a depreciating asset.
We've looked at the data straight from Millionaires, the harsh realities of depreciation and negative equity, and the massive opportunity cost of tying up your monthly cash flow. All of which leaves us with one final, vital question to ask yourself the very next time you step onto a car lot and a dealer asks what you want your monthly payment to be. Are you funding your own financial freedom, or are you just financing someone else's? Thank you so much for joining me for this explainer, and I really hope this data helps empower your next big financial decision.